for both of those courses, I actually studied overseas. I did get an opportunity to work in the US for a little bit, and then I worked in India starting from 1999 to 2004. And then there was a very interesting part of my career where, for some reason, one of my clients recommended me to try and work for a bank. I don't know what he saw in me. He obviously saw a lot more than what I saw in myself at that point in time. And in 2005, when Deutsche Bank was starting its retail India presence, I was very, very fortunate to get to be a part of that organization. And that's how my journey began. So while I was not professionally trained to be a finance person, everything that I've learned over the last 17, 18 years has been on the job. My last assignment was actually I'd set up an investment advisory company based out of Gurgaon, which was acquired by Scriptbox late last year. And I'm now part of the Scriptbox client relations team. I am based out of Gurgaon, and whereas the corporate office for our company is in Bangalore. Scriptbox is actually India's largest digital wealth manager. We started in 2012. We have about 90,000 clients. We're managing upwards of 6,000 crores in assets. And everything that we do is digital. And we try and utilize the power of data and science to be able to bring to our clients accurate analysis of what we feel is going to, is the right way to approach investments. So what we're going to do today is talk about that. I'm going to share my screen, Vikas, now.
Just one comment I want to make, guys. Please mute yourself. Otherwise, I will have to mute you all, and then you will not be able to unmute to ask questions. Okay. If we get noise again, I will mute everyone, and Anurith, I will enable your mic again. Okay, please.
All right.
We are still getting some noise, so I'm going to mute all attendees. Go to mute. It should be okay now. Yeah, noise is gone. Anurithji, go ahead, please now.
Okay, so my voice is still audible, right?
Yeah, it's still audible.
Sure. So, like I said, what we want to do today is not talk about, what funds are doing well, what funds are not going to do well. We don't want to, indulge in that. A large part of this presentation is about evidence-based investing. We will show you some very interesting data points and some of the topics that we will cover in the market today. Is that given the fact that a lot of this audience is specializes in a different domain, we will briefly touch upon what capital markets are. And I'm sure you are experienced in doing you making your own investments, but we're going to talk a little bit about capital markets. Asset allocation is a very, very large part of everything that we do in personal finance and while making personal investments. We will touch upon asset allocation, all the things that entail it, what it is, how it's relevant. The third one is actually the most interesting of them all, because a lot of the times we get asked this question that, whether you should try and time the market or should you spend time in the market, right? So we will spend some time addressing this as well. We will briefly touch upon retirement planning. We will talk a little bit about that. And again, and some of these are extensions, right? Insurances, why term plans, medical insurances, a little bit about international investing as part of diversification. We will show you correlations between international equity markets and the domestic Indian markets. And we will sign off with another question that gets asked very often: do budgets impact equity markets? So because, when we go ahead, there are certain sections where I'd like to engage the audience. So if someone wants to, give us an answer, we should let them give an answer at that point in time, or if they have a question.
Cool. So what I've done is I've muted everyone for now. If you have a question or if you want to make a comment, just raise your hand and I will unmute you.
All right, perfect. So while we are from a different domain, while all of you are from a different domain, I think we've all heard of who Warren Buffett is. And I think that as a man, he needs no introduction. And of all the various things he said, I think this is one of the more interesting ones that I like. And again, it is with regards to investments as it is with regards to everything else. And it basically says that you only have to do very, very few things right in your life. So as long as you don't do too many things wrong, because every time you go off track, it takes a long time for you to come back. So that's broadly the agenda of this presentation. That when we invest using a little bit of evidence and data and science, you'll end up making fewer mistakes. And I think that's what is going to lead us to become extremely successful investors. Okay, so before we begin, and again, I'm going to put out 6 or 7 questions out here. You don't have to answer them, but these are in a question form. And I think you should give the answer to yourself. And again, what this really does is it'll tell you how much you know about the markets. And as a result of which, I hope you'll pay more attention to the following slides. And again, if you know the answers to some of these basic questions, and I think, you'll understand a lot of what I'm suggesting in the first time. So, again, there is fixed income instruments, and then there is bank fixed deposits, right? They both have different taxations, right? So, if you're aware of what is the taxation on a bank fixed deposit and debt funds, it's an interesting question. Do we know the difference between Section 80C and 80D of the Income Tax Act? Do we know what a term plan is? Do we know what it does? And do we know what a TROP is? Basically stands for term return of premium. Do we know the difference between a standard health insurance plan and a top-up plan, right? Again, it's an interesting question. I hope you know the answer to that. Every one of you possibly drives a motor vehicle, and you end up buying a motor insurance. There are 3 main parts to it. There is an IDV, third party, and OD. Do you know the difference between these, and do you know what these are? And finally, do we know what the current rates for the public provident fund as well as the employee provident fund? Right. So, like I said, I don't need an answer to this. And I think if you know the answers to these, then I think you're well on your way, at least in terms of some basic understanding of what we're doing. And like I said, while we may not aspire to be market experts, but I think it's important that we understand some part of the capital markets and how they work. And I think a lot of this will help us in future investment decisions that we take. So let's step back and let's analyze, when we're investing, what would be the 3 main journeys that every one of us have, right? For someone who's starting off their career, maybe in the 25s, 30s, 35s, even maybe up till about 35, you're in some sort of a journey which is called accumulation. You're earning wealth, you're accumulating wealth. Then there is this period of time when there is the growth period, because you've accumulated and now there is the growth. And then there is the withdrawal, and this is essentially happening when you're kind of retiring, right? So you're accumulating, growing, and withdrawing. For this to be able to accumulate, grow, and withdraw, we need to be able to create, protect, and preserve our wealth, right? So for each one of these 3 stages of our investment journey, there are investment ideas. So let's see what these are, right? So when you're creating wealth, when you're trying to create wealth, or you're in the wealth creation journey, some interesting products that we should look at are obviously equity mutual funds. You will see the word equity every time there is wealth creation, simply because it's probably the only investment instrument that can comfortably beat inflation. It has been proven time and time again. So when you want to create wealth, you need to be able to run faster than inflation. Otherwise, you'll essentially end up degrowing your wealth, right? So equity mutual funds, equity portfolio management services, real estate investment trusts, alternate investment funds, and structured products. So again, we're not getting into the detail of what these products are. It's an overview of what we're going to talk about. When you want to protect your wealth, you obviously take life insurance. It obviously doesn't give you a salary, but it gives you insurance on your life that should something happen to you, you are adequately protected, or your family after you is adequately protected. Health insurance, I think it's a no-brainer. Health expenses are absolutely exorbitant these days. They continue to inflate at over 10% per annum. Imagine, falling ill, not having health insurance, and utilizing your own funds to pay for health. So health insurance is part of wealth protection, and general insurance, motor insurance, home insurance. So you're basically protecting your assets, right? And when you're looking at some sort of preservation of wealth, you will obviously switch gears and you will move on to more passive investments, more, on the debt mutual fund side, you will look at bank fixed deposits, corporate fixed deposits, which are issued by corporates, PSU and PSB, so public sector undertakings and public sector bank bonds. and of course NCDs, right? So that's a broad overview of what everyone's investment journey should look at. And asset allocation essentially is a part of all of this, right? So it'll encompass all of these things. When we talk about investment, I think it's extremely important to be able to fix some of our investments to long-term goals. And these could be, let's not say long-term goals, let's just say any financial goal, right? It could be a short-term, a 0 to 3 year, a medium-term, maybe 3 to 5, and anything which is long-term, 5 years and beyond. So when you want to make investments and you have certain goals, right? And let's assume these goals are risk-free investing. A lot of the times people tell me, Anirudh, I'd like to invest, but ensure I don't lose money, right? That's an investment goal that you have. Or I'd like regular income, or I'd like to grow my wealth substantially. If you look at the bottom of the screen, you will see that, you've got things like in products in lieu of, right? So when you look at the boxes shaded in white and you look at risk-free investing, so when you do not wish to kind of see that you're going to lose money or, end up, eroding capital, you invest in a category of mutual funds which are possibly the lowest risk, money market mutual funds, ultra short terms. Most people don't understand these products and they continue to retain money in savings bank accounts and for those who are business owners in current accounts. But if you notch up a little bit, you will end up making higher returns, and it's obviously risk-free. Plenty of substitutes for bank fixed deposits, short-term mutual funds. For someone who looks at regular income, there is a product available for that. If you want stable returns, again, these are products ideally, investable in lieu of direct equity, which will offer you substantially lower volatile products. So some sort of a hybrid mutual fund or possibly a large cap mutual fund. So again, this gives you an overview of some categories that you can look at when you're investing through goals. And then there are a lot of people who say that, listen, I don't know where I want to invest, but I'd like to invest for, let's say, over 5 years. So you look at a grid like this and you believe that, to take the maximum amount of risk in order to be able to give you the highest return, you also need to be invested for the longest period in time. So if you have an investment horizon, and I'm sure some of you make investments, right? So I think this would be some sort of validation of what you do, or possibly some sort of a realization that whether you're investing correctly or not. So for example, you look at 60 months and beyond, and you see that equity mid and small cap funds fall in that. Now I know a ton of people who actually make investments in equity mutual funds which are small cap, and they want to invest for a period of 1 year. It's probably the worst thing that you can do to your money, right? Because as you will see later, that the possibilities of making losses in an aggressive instrument in an extremely short period of time are very, very high. So there is this grid like this, which actually should be able to juxtapose where you want to be to some of these investments, so you're able to categorize well. So like I said, I'm not going to go too deep into capital markets because some of you may have sufficient knowledge. But this was some part of the introduction. And now let's talk about asset allocation, right? So what is asset allocation, right? In a nutshell, it's allocating portions of your investable surplus across multiple assets. What could be multiple assets? The most commonly held for assets on the capital market side. And I'm not talking about things like real estate and things like that. Just talking about capital market investments. It's equity, fixed income, maybe US equity, gold, right? These are 4. As you're able to apportion a part of your investments across these 4 assets in percentages best aligned to your own risk and horizon, that's an asset allocation, right? So basically what it means is you're investing across multiple asset classes. And we will show to you that the correlation between these is extremely important, which means they all don't move in a linear journey. So all of these assets don't move up together and all of them don't fall together. So they will move in opposite direction. So what asset allocation does is essentially it'll help us achieve our desired outcomes, right? So like I said, everything doesn't move up and down at the same time. So when one asset class may outperform, the other one may not do well. And when an asset class is doing extremely poorly, the other asset class will do substantially better than that, which means it will protect you on the downside as well. Now, this picture, I wanted to ask the question, but anyways, the answer is out here, is of an extremely legendary fund manager called Peter Lynch, right? He managed the Fidelity Magellan Fund from 1997 to 1990. Now, under his fund management, right, when he was the fund manager, the fund averaged a CAGR of 29%. Right? Vikas, I think some mics are on, and I think there is a
Yeah, I muted
conversation
again.
happening.
I muted
Sure,
again.
sure. So under Peter Lynch's management, the Magellan Fidelity Fund delivered an annualized a return of 29% compounded, right? That's what it did. However, according to Fidelity Investments, the average Magellan Fund investor lost money during that tenure. The obvious question that you'll ask yourself is, how can a fund that can deliver 29% lose money for its investors, right? It's extremely simple. People don't hold on to their investments. They pull the money out when markets are falling, and then they try and time their way back in. And as a result of that, your entire investment cycle journey is broken. And while the fund, because it's constantly in existence, will continue to deliver great returns, but as investors, you may not make enough money, as a result of which you will lose confidence in the markets, right? Now, some of the slides that you will see after this will prove to you that the longer you hold on, a lot of these risks mitigate, and why we should hold on into markets even though they're falling. Greed and fear, I think, are two extremely important aspects when it comes to investments. Like, there is this commonly used term these days called FOMO, right? FOMO, and that basically stands for fear of missing out. Now, what FOMO does is, when markets were at 64, 63, 62, 62 and a half thousand, 63,000, anyone who hadn't entered the markets wanted to enter at that point in time because they feared missing out, that what if it reaches 65? So what you did was, because the market, I mean, hindsight, we know, right, that was the time to be fearful, because, you obviously, at some point in time, the markets are going to come down. But the mistake the retail investors or most investors make is they try and time the market by entering when the market is already high. So, we are greedy when we should be fearful, and we are fearful when we should be greedy. Like, for example, when the markets fell at 26,000, we were all fearing 2 years ago on COVID. And I had a ton of people who wanted me to say, let's pull our money out. And I said, because they were fearful. But anyone who was sitting on cash and they invested their money at 26, 27, even at 30,000, at 60,000, you would have effectively doubled your money. And so greed and fear are two extremely big obstacles that will always come in the way of investors, as well as their investment objectives. No matter how rational we try and think we are, no one likes to lose money. But like I said, you will see in part of this presentation that, a lot of these fears gets taken away once you adjust yourself to the way markets behave. So, like I said, how does an asset allocation help someone like us, right? So if you work with us, we will understand your desired risk, your time horizon. And once I've been able to understand that as per your risk profile, we create a portfolio which will then protect you as a downside. Because no one minds when the portfolios are giving double-digit, triple-digit returns, but we have a huge problem when portfolios are returning negative. So we have to be careful and protect portfolios on the downside. So that's asset allocation for you, right? Sure. So let's look at the asset allocation for Indians, right? So if you look at this chart, it's actually in 5 columns. So if you look at the total amount, right, it's the first column. So this is actually, I would say it's coming off a COVID year, right? Because 2018-19 was a COVID year. So you would see that the biggest drops between 2019 and 2020 are actually from direct equity and equity mutual funds. That's because it's obvious, right? When the markets are lower, when we're losing our jobs, or something else is happening, and there is this entire fear factor and negativity in the markets, we tend to pull money out from equity markets. And this is exactly what I said to you in the previous slide, right? And where did the money go? There's a 45% jump between 2019 and 2020 on the savings bank deposits. We essentially pulled our money out. So everything that could pulled out of direct equity and mutual funds essentially went into savings accounts. And of course, 15% increase in cash that we're holding. So 60% of the overall, change actually happened in these two asset classes. So again, it ratifies what I was saying previously. And that's that. So let's look at this.
On the previous slide, the current deposits, that's like the current deposits say minus 72%. That means the business was not happening and money was not going into current account, or people were taking out money from the current accounts.
Yeah, that's what it means. There's a reduction in current accounts. People pulled money out of current accounts.
Oh, they took it out. Okay.
They took it out. Yeah, that's the negative. Yeah. As part of asset allocation, like I said, asset allocation means you're invested in various assets. We want to demonstrate to you some data, with regards to returns and correlations. And we've picked 4 asset classes. Like I said, in the capital markets, there are broadly 4. There is the Indian equities, there is Indian fixed income. Fixed income basically means debt investments. There is US equity, which is an asset class in itself, and then there is gold. Now, each of these profiles have different characteristics. So let's take a minute to understand what this data is. So basically what's happening is, if you look at the first line, right, this is the annualized return of the Nifty 50, which is our Nifty 50 index, right? In the 23 years for worth of data that we have, 24 approximately, the Nifty has averaged a return of 14.3% annualized, which means if you invested in 1997 and you held on till date, your portfolio would deliver Nifty 50, only Nifty 50, right, would deliver 14.3%. Had this money been invested in the S&P 500, which is the US index, right? So there is 4 broad indices. There's the Dow Jones 30, which is mostly industrials. There is the NASDAQ 100, which is only the tech companies. S&P 500 is everything else. And the Russell 2000 is only small caps, right? So we're only talking of the larger universe. That S&P 500 universe delivered 11.8%. Gold delivered 10.8%, and Indian fixed income delivered 7.5%. That's the 24-year track record. In the last 10 years, you will see that the deviation isn't that much. They're pretty much in line with their long-term averages. The average 10-year return of the Nifty is 14.6%. S&P 500 is 10, gold, and so on and so forth. What's interesting is if you look at the standard deviation, right? So I don't want to make this too complicated, but standard deviation basically means what is the deviation of a particular index, in this case, from its long-term returns, right? So if you look at the 10-year standard deviation and you look at the Nifty has delivered 14.6%, right? Which means it could be either lower by 4.1% or it could be higher by 4.1%. So the lower the standard deviation, the better it is in terms of volatility. And if you look at the S&P 500, the ranges are slightly higher. Look at the 1-year return of the Nifty. It's an 18%, right? But look at the standard deviation, it's 28, which means that if you held on for a 1-year period, there is a possibility that you could actually be negative returns, negative 2%, or you could be 40% return. So the shorter the duration of your holding, the greater the risk, right? And that's what we're seeing out here. So yeah, that's something. Let's understand the correlation between two. And this is where asset allocation plays an absolutely important part, right? So Indian equity, for every 1% return on the Indian equity, right, the US equities move up by only 0.29, right? And gold and Indian fixed income are actually lower on that trend. Right? So basically what's happening is if you have all 4 of these in equal proportion in your portfolio, you won't make 1% or you won't make 1.29%, but you would obviously, certain investments would also give you negative returns. But the reverse is also true, that when US equities and Indian equities will do very poorly, you would expect gold and fixed income to do substantially better. So that's a good example of how assets are correlated. In this case, equity and gold typically have an inverse relationship, which means if equities are going to do well, gold will typically end up giving you a negative return. But that doesn't mean we don't have it in our portfolio. We need to have everything in our portfolio. The only thing that matters is what percentage you hold some of these investments in, simply because they'll all, kind of give you a greater protection on the overall portfolio. So that's where we are. Let's look at this, right? So asset allocation. Here we haven't looked at US equities for a change. We're only looking at India equities, equity, gold, and debt. Now, historically, what we've seen is, and again, as someone who's done this for close to 2 decades, the first thing people come and ask me is that equities are doing phenomenally well at this point in time. Let's invest our money in equities, right? So that's called a recency bias, right? Something that has just happened or is presently happening as we speak. We tend to want to invest in that asset class, right? However, what essentially happens is that the winners will rotate. So have a look at this data. If you look at it, the first time is financial year 1999. Equities in that year actually delivered a negative 3% return, but debt gave you a positive 13, and gold also did negative. The asset class rank, these 3 sections out here, shows that number 1 is the best performing asset class in that particular year. And it goes to number 2 in the second year, which means that equity, which was the worst performing asset class, actually became the best performing asset class. So from a -3, it became +42. Now, had you invested at 42, it would have gone up to become the worst for the next 3 years. So -25, -3, -13. And then when you feel, listen, I'm sick and tired of equity, it comes back with the 81% return. So when you try and chase one particular asset class, more often than not, you'd end up getting hurt, right? Financially. So as this is indicative that in no particular year, does an asset class do well and it continues to do well. Sure, like I mentioned, you'll see equities probably have the largest number of ones because the longer you hold on, the more money you will make. But for that, you need to hold on, right? So this is another note on asset allocation and why we need to diversify our investments.
Anirudh, any data on property? How did property do as compared to other asset classes? I mean, that would be
No.
to have in the comparison.
Probably I think we don't have it at the moment, but it's a good point. Like I said, we were trying to focus on equity markets. We don't have data for property at the moment.
Yeah, that's okay. Cool. Thanks.
Sure. So again, I think an indication of the previous slide is, higher returns will always come at a price, and that price essentially is patience. Let's look at this slide. And this is a slide I personally like very, very much. This basically means that, historically, right? When you look at it historically, so this is year 1 to year 37. This is data which you've taken from the Bombay Stock Exchange. If you hold on for a period of 1 year, right? This is year one. It's entirely possible that you may make a 94% return, but it's also possible that you may lose half your capital. So the range is 94.0 to minus 52%. When you hold on for 3 years, the chances of making a loss would decrease a little bit, as will the returns, because you can't sustain a 90% return forever, right? So if you look at a 3-year convergence, it's minus 13 and plus 35. And the more you remain invested, so if you look at year 10 suggests historically that if you hold on for between 9 and 10 years, you shouldn't ever make a loss in equity markets, no matter which direction and no matter what COVID or what war or any financial crisis. If you hold on your investments for between 9 and 10 years, there is no way you should lose money, right? Again, subject to caveats and disclaimers like asset allocation and so on and so forth. And the maximum return you can actually make is 28%. But if you hold on for even a longer point of time, look at 30 years and 37 years, the returns have converged. So it really makes no difference what minimum and maximum is. So, when you look at the rolling returns on a macro perspective, you will feel that the shorter your investment period, the more your chances of making a loss, the longer you hold on, irrespective of any occurrence in the market, you should not lose money. To elaborate this, I'm going to show you another slide, right? Let's look at this. Equity returns are not linear, right? Basically, they're not ever going to go up in a single direction. And each time we try and time the market, like I've been saying in the last few slides, you'll end up getting hurt financially. Now let's look at this data, right? It's extremely interesting. Now this is a 16-year data point, right? So Nifty 2005 to 2021, had you invested 10 crores in the Nifty 50, right, from 2005, and you'd held on the entire period, right, you would have returned a 14.7% absolute annualized return on your investment. So 10 crores would have become 104 crores. Now imagine you've exited the market. So 2005, the most recent event from 2005 for those of us who were investing back then was the global financial crisis, right? Everything toppled. We were down 50% in that year, and you exited, right? But even during the period of time that you were outside the markets would have given you returns on certain days and certain periods. Now, in trying to time the market, excuse me, I'm not sure where I stopped presenting. Sorry. Yeah. So basically, in trying to time the market, you would have missed the 5 best days in that entire period. Your return falls from 14.7 to 11.7. Now, you'd wonder, it's only 5 days, but you can see for yourself what a huge drop. You almost lost half, right? From 104, you come down to 66. And this goes on. So, you miss the best 50 days in a 16-year period. And you actually end up with negative returns, right? So if you can see that, so you miss best 30 days, you're never going to make money the more you try and time the market. And that's why we're huge advocates of the fact that, disciplined investing is obviously the best way to invest. It's exactly the same as the previous slide. All the red dots that you're seeing are market tops during those years, right? So if you look at from 1997 to 1999, the market made several highs. And then between 1999 and 2000 and maybe four, the markets essentially did nothing for that entire 4 and 5 year periods. And between 2004 up till 2007 and 2008, the markets continued to become higher, and then you can see they fell. But if you've continued to stay invested, that's what I was saying, that the longer you stay invested, the markets will continue to give you highs. Don't try and time the markets will fall, and then they're going to rise again, right? That's what markets do.
Anirudh, there's a question in the chat. Bhai, you want to unmute yourself and ask the question? Anirudh, you want it interactive, right? Or shall we take questions at the end? How do you want it?
We can do the question now.
Yeah, hi. So just a question on how do you figure out that best day? The previous slide that you mentioned. So was it a single particular day, or was it a range, let's say a period during which the market remained negative, and any of those days during that, let's say a week or 10 days or 15 days period would have been considered as a best day?
So this would be actually data. So basically, once you've exited the market, and the market at some point in time would have given you an exceptionally high return, right? So there would be days when, for example, I don't know whether you remember, there was a time when the results for the elections came out and the markets actually hit upper circuit 20%, right? That would be considered a best day, because in the entire lineage of the market, there would be certain days when it's actually been able to give the highest return, because of which the entire. So, for example, 2 years ago, when bank capitalization happened, when the government capitalized banks and PSU, index went up by 30% that day, 25%. So days like that would be considered the best days. So if you miss out on some of those days, in the entire period, because the markets are always falling and rising. So, and I'm not saying you have to be out by only 5 days. You could be out for 6 months, and the markets gave you certain highs on those days. And that's where this data has been derived from.
Okay, thank you.
All right. So again, we get asked this question: what is the best time to enter the market? So let's give you another statistic. When the BSE Sensex was started on the 1st of April 1979, they assumed at the base value of 100 points, right? Today it's at 58,000. That's 16%, just up under 16% annualized return. Every single thing that could have possibly gone wrong within this last 40 years or would have gone wrong. Yet somebody who invested and remained invested would have obviously made money and comprehensively beaten inflation, because that's a 16% return. Here's another fact, right? For people who try and time the market. This is data from 1990 all the way to 2020. The red line is every time, and this is for a monthly SIP of 10,000 rupees, right? So we're not talking of 10 crore numbers and lump sum money. This is saying someone's trying to do an SIP, right? But you try and do an SIP each time the market, in your opinion, is the lowest in that particular month, versus investing on probably the best day of the month. I mean, see, you invest, right? But you don't know what's the worst day of what's the best day. But look at the end of what's happened, right? A 10,000 rupee SIP, had you invested at the lowest point every single month in the last 30 years, the total return would have been 2.84 crores. And had you invested in the best particular month, which means at the absolute height of the market, it would have been 2.62 crores, right? Now, when you look at that number over that period of time, it actually is testament to the fact that there is nothing called timing the markets, because you don't know what timing the market is, and as a result of which, it's the time in the market that will determine whether you actually end up making money or not. So that's something else. Now let's look at volatility and so on and so forth, right? So let's look at the chart on the right, right? It's exactly one on the left, but I'm trying to show you data points on the right. And, because of the OTTs and, now we've all seen what happened in 1992. So the markets actually collapsed because of the Harshad Mehta scam. All the greens are positive events and all the reds are negative events. There was this entire tech boom, 1998, 1999. And then, of course, it became very, very quickly, it became a tech bust. And at the same time, we had Kit and Parekh and all of the negativities around that. Then, of course, we had this phase where, the bulls went absolutely crazy. And then they, of course, fell during the US subprime crisis. The NDA government came to power here and so on and so forth, right? So That's what's happened, geopolitically, macroeconomically, and everything that could possibly happen. Look at the chart on the left and look at the top line. This is what happens when you track the market on a daily basis. It's extremely volatile. It's like an ECG machine, right? It's continuously moving. Step back 5 or 6 paces and you see that the monthly charts don't look as bad as the daily ones. And then you look at the yearly chart and them. And then you look on the right hand side, right? And you look at a 3, 5, and 10. Anyone see a difference between daily and maybe even a 3 yearly, right? It's a smooth linear line, because what you're doing is you're now stepping back and you're saying that I'm not interested in looking at the markets on a daily basis. I'm interested in where my money will be in 3 years and 5 years from now. What I'm suggesting is that despite the volatility, now I showed you in the previous slide, right? You would have redeemed your money here, but it gets covered in a 5 and 10-year graph. It doesn't matter whether the markets have fallen or not, because invariably they're going to end up going up, right? So there is no volatility when you have a longer term horizon, right? Here's another statistic for you. Now, people fear crashes, right? Now let's look at this. Now, these are some 6, 7 events in the last 20 years where markets have absolutely fallen, right? So even if you invested before, now, if you look at column number 2, right? So in the dot-com bubble in 2000, the markets lost 50%. You would have still made a 12% annualized return had you invested prior to this crash. Do you understand where I'm coming from? So if you invested in the year 1999, you may have lost 50%, but till today, from 2000, you would have still made 12%, which is higher than debt and higher than inflation. So every single time you look at the election uncertainty in year 2004, you may remember that they had a stitched NDA government with Bajpayee as the prime minister in 1999, and they believed they'd done a phenomenal job, and they had this incredible India Shining campaign all through 2004, where they were absolutely convinced they would come back to power, and they did not. And the Congress came back into power with UPA 1, and the markets took that extremely badly and they collapsed. You would have lost money most definitely during that period, maybe for the next 6 months. But 15, 16 years from there, you would have actually ended up making 14% return. COVID, that's the most recent example. You've lost 40% in March of 2020, but despite losing 40%, you're actually up 20%, which means that imagine had you invested at 26,000, this data suggests that it's minus 38 plus 19, you actually would have made close to 60% return, had you invested. But we're not trying to time the market. What we're saying is these bad events would always happen, and we've beaten inflation and we've beaten debt, right? So that's what the indication here is. So while we've spoken about, why one shouldn't time the market and why time in the market is important, we've got certain goals which are obviously longer term. Like if the general audience here is, let's say, even 48, let's say even 50, right? And in normal sense, we would like to retire 8 or 10 years later, we still have to plan for that. So why retirement planning is important, right? Because the first and foremost is we all aspire to have either a similar lifestyle or a better lifestyle. I don't think anyone in this audience, and I'll ask this question again when I'm talking to you, anyone here who says that, listen, I'd like to downgrade my lifestyle by 50%. I don't think anyone in the audience is going to do that. And because we don't want to do that, the resultant of that fear or aspiration, we need to plan for it, right? So that's why it's important. Inflation, we've seen that consistently, time and time again, that, inflation is the one, criminal in our lives, which actually eats away into everything that we do, right? It's whether you look at a 5% bank fixed deposit today with inflation at 6%, you're actually making negative returns. Now, that is something that you don't want. So you need to plan well in advance. You need to plan as per your risk and asset allocation, and you need to invest with an idea that you're able to beat inflation, right? Obviously, you want financial freedom, right? You don't want to be constrained after having worked 30, 40 years of your life. You don't want to think twice before wanting to take a vacation, or maybe for buying a gadget or something like that. You need to provide for emergencies. We'll discuss a little bit more about this. So how do we ensure that we remain on track, right? Now, I come from a belief that unless and until every one of us on this group, and even people that we may know, unless you have a great financial picture, you have to, you have to continue to step back and look at everything in totality. And you have to believe that unless and until you have an overall picture of what you want in your financial life, you probably will not be able to take constructive decisions. Research has shown time and time again that people who do not write down their dreams are more likely to do nothing about them. At Scriptbox, we have financial planning as one of our main pivots, where we encourage people to talk about their financial goals and aspirations. And once you've written them down, once you've seen the outcome, or once you're able to figure out how you're going to achieve them, you are more likely to do something about them. And when you do something about them, you'll more likely achieve them, right? So it's important that we ensure that we remain on track, obviously through a financial plan. Now, when can one retire, right? I think that's, again, people ask me when I do financial plans for them, Anirudh, what's a good age for me to retire? I don't think there is a correct answer. Maybe when I was 30 years old, I want to retire at 60. But at 42, I think maybe 50, I'd like to retire. So it's a moving goalpost, right? But 60 is what most people want because you're able to work till then. But today, along with your financial stability, it's also a psychological decision. When it comes to, so what is it that you're going to do when if you have all the money in the world and you're 45 and you say I don't want to work a single day in my life? What is it that you're going to do for the remainder of the 40 years? So there's a lot of other metrics that go into retiring also. But it's about you being ready. Like I said, you can't wake up tomorrow morning and say, okay, I'm only going to read the newspaper and go out with friends. So you need to be prepared for a lot of the things that's going to happen for you. So from a financial perspective, right, because this is a financial acumen session, from a financial perspective, retirement can set into some of these, see which of these work for you, right? That everything that you need for your retirement is available, because at the end of the day, money is the greatest denominator in all of this, right? If you don't have it, then nothing's going to happen, right? You are financially independent, and everything that you've aspired for, be it children's education, be it children's marriages, being something else, it's all been provided for. You're covered from a medical emergency point of view. You have no more debts. You have adequate health insurance. And because of this, we've been able to, kind of philosophize this retire well approach, where we say that, important to gain an overall picture. So we've got like these 4 steps where we say that, it's important that you have assets. So you have a house to live in, you have basic utilities, you have a transportation, and you have a guaranteed source of income, which is going to cover all of these 3, right? So that's important, right? So that's the first and foremost thing when you talk about retiring well. You prepare for the unexpected, today, like a loss of job or being without a regular stream of income. So you need to ensure that these gaps are plugged, right? You want to ensure a similar lifestyle. I just alluded to it in the past. I don't think we would like to have a downgrade in a lifestyle, and we would certainly, wouldn't want our retirement to get derailed because, of an accident or a disability. So we need to ensure that. And of course, the last thing that everyone does is you want to leave a legacy, whether it's for your children, whether it's to charity, whether it's something else. So when we talk about retirement, there is some interesting strategies where you can retire with a corpus, and then you have to figure out what to do with it. So there is something called an SWP. It's called a systematic withdrawal plan. It's much like a systematic investment plan, except that in the SIP, you are the one making an investment into the fund. And a systematic withdrawal plan, the fund's actually the one which is returning money to you, right? So if you look at these examples, so we've worked forward from where we are. We've taken 2 broad assumptions here. There is someone who, let's say, invests 25 lakhs and you wish for an STP immediately, right? So if you look at this, if 1st of May 2022, you invested 25 lakh rupees and it's growing at about 10% per annum. So we haven't taken extraordinary returns, but we're withdrawing 1% per month. So in this case, the growth that is happening is 10% per annum on this fund, and the withdrawal that is happening is 12% per annum, right? 12% per annum. What you'll notice is that at the end of the period, you would have actually withdrawn a substantial sum of money, and you're still left with about 22 lakh rupees, right? So that's what's happening. So a systematic withdrawal plan essentially can be built for a retirement monthly income flow. The most important part of this particular illustration is at some point in time, this illustration, the money will run empty, right? Simply because you're withdrawing more than what you're earning, right? So because, like I said, the growth rate assumed is 10%, the withdrawal rate is 12%. However, if your portfolio continues to generate an excessive return to your withdrawal corpus, you will never run out of money, right? So if you do the reverse, if you're generating 12% and withdrawing 10%, you will never lose money. In fact, you will never run out of money either. So it's extremely simple. And like I said, this is a generic example. If some of you or people from this audience work with us, we will obviously create some of these strategies which will be, customized to you, and we'll explain a lot of these, facts and some of these terms, etc., in detail. On retirement, this is very interesting, right? So about 2 decades ago, World Bank in 2001 actually pointed out that 24% of every single Indian who was hospitalized in a particular year slipped below the poverty line because they were hospitalized without having any sort of insurance, right? A more recent report on out-of-pocket expenses published about 2 years ago suggested that 70% of all healthcare expenses incurred by Indians are from their pockets. And of that 70% is spent on medication alone, right? Which obviously leads to impoverishment. So, we may believe that, nothing is going to happen to me, but the reality, nothing could be farther than the truth, right? That you don't know which one of us may fall ill. And, I think we've just coming out of a medical pandemic, and we've seen that, it doesn't matter how much money you have. But the fact of the matter is that despite knowing all of this, despite COVID, less than a fifth of Indians are actually covered under health insurance. We tend to rely on our employers for health insurance. We tend to rely on other sorts of things. We believe we have sufficient money to take care of it, but we don't have health insurance, right? I think this is a good starting point for some of us in this audience who may not have health insurance to start thinking about this, start thinking about this in a little bit more structured fashion. So let's talk about, while we're on the subject of insurance, what is insurance, right? So insurance is not meant to gain from. You cannot gain from insurance. It's mostly you're indemnified against the loss, right? So what it will do is it will put you in the same position post the loss as you were pre, right? So for example, if you owned a car worth 50 lakh rupees and it's completely totaled, the insurance company will not give you 60 lakh rupees. It's not going to benefit from it. At best, it will put you in the same position. So you'll recover what you've lost, right? And that's what insurance essentially does. Now, I'm going to go through this fairly quickly. I don't want to take too much time discussing this. So I'm not sure where we are on time. Yeah, we have about 10 minutes. So broadly, there are term insurances, there are ULIPs and life insurance policies. And of course, there are health plans and top-up insurances. There is also in the middle of all of this something called a pension plan, which offers you regular incomes. And then, of course, there are ULIPs, which is a combination of savings and protection, right? And investments. Taxation, very important. Most of these, barring pension plans, are exempt under section 1010D. That's 1010D is the withdrawal stage, right? When you withdraw money, the returns are taxable or non-taxable. Pension plans are always taxable because pension is construed as income. Income, it's added to your existing income and you're taxed. However, for ULIPs, while section 80C can be claimed at the time of making an investment, the limit, of course, is 1.5 lakh rupees. But if the cumulative premium across all your ULIPs is more than 2.5 lakh rupees, as per the budget last year, the returns would now become taxable. Of course, for numbers 2, numbers 2, 3, 4, whole life endowment and money back, which are basically traditional plans, the returns continue to be non-taxable. For health insurance, of course, if you take an insurance plan for yourself, up to 25,000 rupees is deductible under section 80D. Health insurance is the only thing that is a part of 80D, so you can't take something else and claim it under 80D. So if you don't have health insurance, it basically means you're not claiming section 80D, which means you're paying up more tax than you have to. So that's food for thought. Very quickly, how do you build up to children's education? Some of you may have children out here. What we've done is we've picked 3 very popular courses, MBA, engineering, and medical, because they obviously have different years. What we've done is for the management program, we've taken the IIM Ahmedabad, the BTech program. For the engineering program, we've taken the IIT Bombay 4-year program. And for MBBS, we've taken the Manipal University. Now, these are the standard costs of the entire duration of the course in the year 2018. Now, if your child is about 14, 15 years to college, right, which means he or she goes to college in 2023, The inflation that I was talking to you about gets levied here, and typically there is a 10% inflation. That is, most of our children go to school, and the fees get increased by 10%. So you are actually seeing that the cost of these are becoming exceptionally high, but there is some sort of savings if you're able to, put SIPs in place, etc. So what we've done is we've kind of just shown you an illustration of what inflation can do and how this can be mitigated in smaller tranches of either 14,500 rupees going up to 40,000 rupees, assuming a 15-year SIP, also assuming an investment return of 12%. If you cast your mind back to some of the earlier charts, if you've held on for 12 years or 15 years, you should actually end up making more than 12% return. But like I said, this is just to kind of show to you how inflation is creeping into our lives more than we realize it, and how much we need equities for the longer term to be able to beat inflation and also save for some of these goals. In the end, I'm going to discuss the budget impact for investors. Everyone's always interested whether taxes are going up, taxes are going down. Unfortunately, there was no change in the direct tax structure. Direct taxes are, of course, those taxes that are levied on income. So there was no change there. However, the new craze, crypto and digital currencies, the government, while may not have legitimized it entirely, but what they've said is, if you earn an income, we will tax it. We don't care whether it's legal or illegal. If we find out, we will tax it. So now anyone who holds digital and crypto assets will be taxed at a flat 30%, no indexation, no offsetting of losses, no carrying forward, etc. And to make sure that they know who you are, there is also going to be a 1% TDS every time you purchase, right? Surcharge on long-term capital gains, which was for the longest time the bane for so many high net worth individuals, which was at 30% and 35% and 42%, will now all be capped at 15% for all assets. So, you may, of course, end up paying a much higher tax on income and so on and so forth, but those surcharges are now capped at 15% for other assets as well. And of course, the government has now introduced its own plans to launch its digital currency in the current financial year. Do budgets impact the market? Impossible to suggest when I look at the data for the last 21 years. The first column is the pre-budget month. Now, please remember that the budget dates have now changed. Earlier, we used to have two budgets till about 3 years ago, 4 years ago. There was the railway budget, and then there was the national budget, which used to typically happen at the end of February. It's now been actually moved. The budgets have been combined. It's now happening on the 1st of Feb each year. As you can see, there is no clear trend. 2 and 20 years, markets are giving you more than 10% return. There have been 5 or 6, 7 instances of negative returns. Budget day impact is the interesting one, right? Because if you look at what happened in the year, for example, even last year, for example, it was not a great budget because, we were in the middle of a pandemic and so on and so forth. But in 2021, when she presented the budget last year, it was taken to be a very good budget in terms of the thrust on infrastructure and so on and so forth. So, and then in the post-budget month, in the year 2001, the markets fell. So like I said, if you look at this data and analyze it, there is no clear trend because in my own experience, when we're nearing this time, people are asking me, I think it's the budget month, I think the markets will fall. I think the markets, let me get it out of the way. This suggests that there is really nothing in it, right? There's nothing in that thought, and there's nothing in the answer that you may get from anyone because the data talks for itself. The only thing that has actually happened now is that the budget has become now more a policy statement or a statement of intent of what the government, would like to do through the course of the year, because they're not waiting for budgets now to make big bang announcements. There's a divestment to be planned, they'll do it intra-year and so on and so forth. So budgets are not impacting the market like they did in the past. Okay. Now, I'm actually at the end of my presentation. I'll take a minute to introduce us as a company. I did speak about us. So like I said, we started in 2012. Today, we are the largest digital wealth manager in the country. We do believe, and I say this, and I've repeated myself earlier also, we believe in the power of data and science. Everything that we do is that. I don't want my personal biases, or none of us in the organization would like our personal biases to influence the investment decisions that you make via advice from us. We believe that data talks a lot, empirically proven information. And once we're able to understand what you need, we've got our own methodology of how we evaluate funds and bring them to you. And of course, it's a foundation built on trust. We're actually now close to 6,000 crores in assets. What is it that we can do for you? Life goals planning, like I said, we do financial planning. Life goals actually goes a few steps ahead of that. Investment advisory, income tax services, which includes your tax payments and strategic taxation, estate and succession planning, of course, liquidity management. And like I said, you don't have to take our word for it. These are some of our clients, who worked with us for several years. There are a couple of testimonial videos also on YouTube. Um, I don't think we had sufficient time to play any of those, but that's what we are. We are based out of Bangalore at the Lira Hotel, at the Intercube space in Lira Hotel. And that is that, because it's the end of my presentation. Happy to take any questions that we may have.
Anirudh, awesome session. It is 6:59, bang on time. And let me say, we conduct online sessions every week on Thursday, 11 o'clock. This is one of the best sessions that I've attended or organized, if I may say so. Really, kudos to you. Amazing session.
Thank you. Thanks.
One question I want to ask, about your services and all. How do you charge your clients? I mean, I'm asking for general interest. Everybody would like to know, okay, if we come to you for consulting, our portfolio and all, what are the charges? And coming via EliteCISO, is there any discount we can get?
So let me answer the first question first. So SEBI, and I'm sure some of you are regular investors. For the longest time, there was just the distribution, right, where you were not paying a fee to someone, but there was the mutual funds that you were investing through banks, and there was an expense. SEBI introduced advisory services, where you would end up investing in direct mutual funds. You may have heard the word direct mutual funds. We also have an advisory services arm. So depending on what someone's requirement is, we typically offer advisory services to those clients who are investing at least 50 lakhs and above in a financial year, and they start with that. You may choose to not opt for advisory services even at 50 lakhs and above. But what that does is, if you opt for advisory services, then there is a fee. The reason there is a fee is because the regulator asks we must charge a fee to our clients for the purpose of giving advice, because the advice is agnostic, right? So we don't care whether we have an interest or vested interest or how much money we're going to make, because we don't make money from the funds that we recommend. We will make money with what we charge you, right? So that's the advisory model. The distribution model, of course, has been the tried and tested model for the longest time ever. The banks, the IFAs, the other people like that. So if someone's opting for distribution, we don't charge you anything. On financial planning, that is a service that we are also currently not charging for, and we will not charge EliteCISO as well. So very happy to engage with any and all of you who would like financial planning.
Awesome.
I'd like to add something here, because if I can.
Is it Dharan? Okay. Yeah, come on camera, please. Yeah, Dharan, go ahead.
So to answer your second part of the question, you asked if there's anything for EliteCISO members. I can float out a feedback form where we are also offering two parts of the services for free. One is the financial plan, and the second one is a free second opinion on your portfolio. So if you have an existing portfolio, you can get a free second opinion on that as well. And if some of you, because we were short of time, if some of your questions did not get answered, you can also ask a question there, and one of our experts will get in touch. So I'm going to quickly float out this form. So anyone who's interested,
I've already posted that. Dharan, and this is the only session where I'm not rushing, in the sense, okay, it is 7:02. Let's kill the session. Let's go home.
Right.
It's been amazing session, right? And people, I mean, you are free, guys. If you want to stay on, you stay on. If you want to ask question, I hope Anirudh, you have a couple of minutes to answer questions.
I have all the time, Vikas.
Awesome. So Abhishek Madhur Bhai, please go ahead, ask your question. And if you want to ask question, guys, raise hand. I'll call the name.
Right. Thank you very much, Vikas. And please confirm if you can hear me.
Yeah, we can hear you.
Thanks, Anirudh. A very good and very nice, insightful session. I have a question. You were showing about those investment opportunities through ULIPs and mutual funds and other stuff. But there's an option of NPS, and as we as an organization have been talking a lot about NPS for our employees. What's your view on this? And other is second part of the question is of the debt, which is like Sukanya Yojana and these kind of debt things. What's your view on that?
Okay, so NPS, right? So I think NPS is, and I'm sure you know the history. It was started only for government employees, and then it became introduced. It became open to every Indian. Now, typically for private sector, the employer may contribute, but let's not get into that. Let's talk about what it does for an individual. Because in the private sector, we're not in pensionable jobs, so the government has tried to, introduce a national, the pension scheme to mitigate, that particular thing of not getting regular income. So for those of you, so firstly, there is a section 80cc-D, which actually gives you an additional benefit of 50,000 rupees in addition to the 80C benefit of 1,50,000 rupees. There are two types of NPS accounts. There is a tier 1 account and then there is a tier 2 account. A tier 1 account is one which is essentially locked into retirement, right? So if you invest, let's say, 1,50,000, so there is no limit, by the way. You can invest any amount of money that you want in an NPS account. And the returns are not guaranteed, they're market linked. But and again, this is very interesting, right? Because first they started off with a very rigid asset allocation model, and now they've kind of freed it up a little. So it's a fairly elaborate graph where, in terms of the older you become, the lower your exposure to equity is. So, for example, at my age, at 42, the most aggressive cycle that you can take is 75% equity. So, at no point in time can your exposure to equity exceed 75%. Now, if I'm in the auto cycle, the life cycle where it auto rebalances, as I become older, my asset allocation will reduce equities and increase debt, right? So, because it's the convergence theory, right? So, when you're near a goal, you must remove yourself from aggressive investments and become into passive ones. So, tier 1 accounts would enable you to make investments basis an equity. There is corporate bond, there is government securities, and then there are REITs. So, there are 4 asset classes that are classified. You can pick and choose. And if you're unsure, you can choose one of the allocated ones, which is mandated by PFRDA, by the way. So everyone uses the same asset allocation. The only thing to note is that if you've accumulated, let's say, 50 lakh rupees in that account, and at 60, you're now retiring, 60% of that amount becomes tax-free to you and fully withdrawable. So if you choose to, so if you don't choose to, everything has to be annuitized. If you choose to withdraw everything, 30 lakhs, which is 50%, 60% of 50 lakh rupees, will come back to you as a tax-free. The remainder of the 40% must necessarily be commuted into annuities. So you will have to go to the provider and say, okay, now pay me pension for the rest of my life. So that's what comes to you as pension. There is a tier 2 account also, which can be used as a regular investment account. So you can invest in a tier 2 account and you can withdraw money at any point in time. However, two things: there is no tax benefit and withdrawals are fully taxable. So only tier 1 account gives you tax-free income at the time of withdrawal, and of course is logged in. Tier 2 account, of course, like I said, is a free account. The final thing about NPS is you cannot open a tier 2 account. Just 1 second, I just want to complete that. You cannot open a tier 2 account unless you have a tier 1 account. So tier 2 cannot be the only account that you open. Once you have a tier 1, you can then open a tier 2 account.
And from tier 2, can you go back to tier 1 and tier 1 to tier 2? Is that possible?
No, you can't move. So there are 2 independent accounts, right? So there are 2 independent accounts. And because there are 8 service providers, right? So there is UTI, Kotak, Reliance, HDFC. So there are various pension service providers. So I give you my example. So I have 2 accounts. I have HDFC in tier 1. I have UTI in tier 2. Because what I want to do is I want to measure the performance of them. So I mean, because when I sell and when I talk about these products, it's important for me to have the knowledge. So I've also kind of put my money in it. So yeah, so you can't put money from one account. It's not like a bank account. These are investment accounts.
Cool, great. Thanks, Anirudh. Next, Kamalji, please go ahead, ask your question.
Thanks for
because just one question. What I understand.
you advise NPS to the people, to your clients.
Oh, most definitely we do, because I mean, as a matter of fact, on Scriptbox, we've tied up with K Fintech, Carvi Fintech, and we use HDFC as our point of purchase, right? So you can open an account using the Scriptbox app. In fact, Dharan, if you can kind of just share that link in the chat so someone can see the journey. So I mean, I'm personally a big believer of the NPS account because it gives me the required asset allocation that I need, that we've been talking about. And it gives me pension tax-free income for the rest of my life when I'm 60 and beyond. And it's a low-cost investment option. The only thing is you have to remember that you may invest 5 lakhs in it, but the tax benefit is restricted to 50,000 rupees because people also make investments. You remember, right? 10 years ago, there were these infrastructure bonds, right, which came out. And everybody was investing 20,000 rupees because that was the limit. 5,000 into 4, so any tax break that we can get, we want to maximize. And I don't see any reason why we shouldn't take that, because if you don't take that, then you end up paying 15,000 rupees additional tax, assuming it in the 30% tax bracket. So why pay the tax when you can actually make an investment?
Yeah, hi, Anirudh. I'm coming in. This is Kamal here. I'll go back to the initial slides where we were talking about asset allocation, and one of the asset allocations were about the US fund investments, right? So I would like to know how to identify a US fund, especially a mutual fund, and how I would start an SIP which generates a good stable return.
Kamalji, that's a good question, but let me disappoint you first by saying that the SEBI recently restricted international investments via mutual funds in overseas in US markets, because several years ago they restricted a limit of about $5 billion at that point in time, because so that is when you invest in mutual funds in India which are subsequently investing in the US, right? So they had imposed an industry-wide limit. And they had also given individual limits to fund houses of $1 billion. Now, recently, that limit was perilously close to the 7 billion. That was the revised number, the $7 billion mark, because of which now they've stopped. Temporarily suspended is the word that I will use. So they've temporarily suspended any investments in international mutual funds, US-based, or in fact, anyone. But US-based is the most popular of the lot. So as we speak, you can't make any investments. But to the larger question of what is a great fund to invest and what's a good geography for you to invest. So at Skribox, we have recommendations as some of our preferred funds, both on US markets and the Chinese markets. Some good funds and these are part of our recommendations, is of course the Edelweiss Greater China Fund. This is a good fund. But the thing about international investing is that other than the macros of a different country, you also have to keep in mind currency, right? Because there is the currency risk that is always prevalent in international funds, because while it's easy to know that we will probably not gain against the US dollar, we're not going to go back to 60. So you don't have a currency risk in that sense. But I mean, if the fund gives you a zero return and the currency loses 5%, you actually end up making 5%, right? Because you're now getting back money in a different currency. But there is the currency volatility also in these funds. And on the US markets, of course, we have two feeder funds that we use. One is the Franklin US feeder fund, and there is the DSP US Flexible Fund. On our advisory platform, we actually use two Motilal Oswal index funds, which is the NASDAQ 100 and the S&P 500. So these are two ETFs. NASDAQ is the ETF and the S&P is the FOF. But currently, Kamalji, you can't invest. You have to wait until the restrictions are removed.
Yeah, another second question to that is...
Sorry, Kamal, we don't have enough time.
Very small question.
I'm so sorry.
It's a general question for everyone. How do we have a platform where I can manage my portfolio? Is there any automated platform where I can keep all my investments and do a tracking of it?
Yeah, so in fact, that's a great question. And I'm glad Vikas, you allowed him to say that, because Skribox is actually one of the things we thrive upon is the idea of consolidation and family wealth, right? So if you're a Skribox client, there are certain investments you may make through my platform, which will be visible to you. We also have something of a feature whereby you can track your external investments on the same platform. So you can upload your NSDL cash statement, which is the common account statement, and you'll be able to see your portfolios on the same platform under two very distinct heads. So what you own with Skribox and what you own outside of Skribox. The difference between MF Central, that I saw I don't know who answered that. I think Anandji, you answered that question. So MF Central doesn't give you a view on your holdings. Skribox goes a step further and says that, listen, you uploaded an external statement. Let me give you my view on it, right? So what it will do is, it will do a portfolio analysis and say that, in our opinion, these are not good funds for you, and you should probably make changes. So it will do a portfolio audit for you in that sense. Not only for you, you can also manage things like your real estate and bank fixed deposits and insurances and employee provident fund and NPS 1, NPS 2. Somebody asked a question earlier about Sukanya Samriddhi, and basically government schemes, etc., can also be added on that. Now, we may not have an auto tracking feature at this point in time, but at least in terms of, it's better than managing an Excel sheet, believe me. So, once you have it on my platform, you'll be able to see everything under one. So you see the whole wealth portion of your family.
Yeah, thank you.
Awesome. Sounds good. Anirudh, for your application, if you want any security assessment, we can do it for free. We are all security geeks.
I have no doubt about that.
Okay, great. Next is Devashish Bhai. Which beer you are drinking and what's your question?
So, time of the hour, Corona, just finished it. And this is related to Anirudh. Firstly, great session. Really loved it. Coming to my question on NPS, coming back to the same question, how would you compare NPS with PPF? We have two options, wherein people would like to put in money and take it as a debt investment, in government proper investment. One is NPS and one is PPF. What are the pros and cons in NPS? You have already told us. What about PPF?
Sure, I'll compare PPF to an NPS because while Public Provident Fund is a fully guaranteed scheme of the government, it has certain restrictions, and the first of them is it has a maximum investment of 1.5 lakhs per annum. So whether you do it on your name or you want to do it in the name of your child, and maybe you have two children and you do 50,000, the best you can do is another 50,000. So cumulative is a lakh and 50 in your name or investing in the name of minor. That's the first thing. While the returns are guaranteed, right? What is not guaranteed is what the return will be. So for those of in this audience out here in the year 2000, 2001, the Public Provident Fund rates were upwards of 12.5%, right? For those of you invested then. And look at where they were, let's say 2 years ago, they were at 8.5%. And in one stroke, on April of 1st, 2019, I think, they brought it down by 140 basis points to 7.1. Now, that is the challenge with Public Provident Fund, that while the returns are guaranteed, what the return will be, you don't know. That's the second thing. And if you can look at from 2000 to 2021, it's almost a 40% drop. Where it will be 10 years from now, you don't know, because you have to understand that the government cannot indefinitely pay out 7.5%. It has to pay out what it is earning, right? So the best external benchmark is the government GSEC. Now the government GSEC is at 6.6, 6.7, which means you can't pay out higher than that, right? Anything has to be under that. That's the external benchmark. So that's the second thing about PPF, right? The third thing is that while returns are entirely non-taxable, it has a minimum lock-in of 7 years. So you cannot withdraw anything before 7 years. And it has a maximum maturity of earlier 15, and now it can be extended in blocks of 5. So let's say you're 57, and if you want to extend in blocks of 5, it will go up to 62. So you can't time it to a certain thing. So 15 plus 5 plus 5 plus 5. So it's extended in blocks of 5 years. When you compare that to an NPS has, of course, no investment limit, right? It has a limit of 50,000 rupees versus 1.5 in the tax exemption. And there are two separate sections, by the way. So you can do PPF and NPS and get exemption for both. So between them, you'll get 2 lakh rupees. And secondly, the fact is you're also going to get the biggest advantage now about with the PPF is, and 2 years ago it would have been difficult because pension returns, NPS returns were taxed. It was under the EET regime. So it was exempt tax. And there was a lot of lobbying by PFRDA and so on and so forth. So they actually made it EEE. So it's exempt at the stage of withdrawal as well. As a result of which it became, an extremely popular option because now it didn't matter how much you accumulated. You'd actually end up taking tax-free returns. So that's the fundamental difference between the two.
And I believe with the ATC and ATCCD, that's one of the difference where you
correct.
Normally or PF, etc. The person we are all going for a job. So PF, etc.
Right.
covers ATC.
Yes. So NPS will give you ATCCD in that sense.
ATCCD, yes. Another 50,000. Yes. Thanks.
Second last question, guys. I'm rushing now. Sumit Bhai, go ahead. Ask your question now. Sumit Malhotra.
Hi. Thanks for the session. Mine is a very simple one. I think you did not touch investments like small cases, which is, I think, very popular now. Actually, I would say getting popular now because there are many offerings like small cases by various other enterprises. What's your view on that versus directly buying equity through, let's say, Zerodha or something?
I'm personally a huge fan of a small case simply because it takes away from me the element of trying to do the research. Now, when you look at equity stock markets, and in a standalone basis, most of us don't have it. See, we may have the knowledge, but knowledge itself is not enough. It's important to be able to understand when to enter and exit, right? Because entering and exiting is a huge part of investing in capital markets as well. What small case does is that it's professional. It's basically baskets of stocks, right? So, for example, it's a thematic thing. So you will find stories like the EV revolution, or the Tata group of companies. So someone's done the research, and it's pocket friendly, right? So you don't have to guess how much money should I put in, because it'll give you 2 to 4, 4, 5, 5 stocks, and portfolios starting as low as 500,000 rupees, going all the way up to several lakh rupees. So small case is a great idea for those people who don't have adequate knowledge, but would still like to invest in the equity markets. That's the first and foremost thing. At Scriptbox, we don't have, at least on the distribution side, we don't have an active advisory. But this is something that we're working on, and hopefully in the couple of quarters, we should be able to put out our own small case out there. But I mean, as a product, like I said, versus Zerodha. So by the way, small case is not it's not an execution platform. It's merely an advice platform. The execution is still happening through an existing broker. So for example, I have a Zerodha account. I log in onto a small case and I link my Zerodha account, and the investments are made through Zerodha. So my DP is Zerodha. My stocks are going to be held on Zerodha, but the advice element, and of course, I mean, I may be paying for it or whatever, that's happening through small case. So I recommend small case to those investors who prefer equity investments, but don't want to put large sums of money and don't have the time to experiment, because it will rebalance your portfolios also each quarter.
Okay, thanks. Before I go to last question, Dhananjay bhai, do you want to come on camera and ask your question? Otherwise, I will give the opportunity to people on camera to ask question. Awesome.
Okay.
Go ahead, Dhananjay.
I'm traveling, so I thought of
that's okay.
So very quickly, thanks very much, Aniruddha. One very quick question. In PPF, you talked about PPF. You can at max can go up to 3 renewals of 5 years or extension, or is it possible to go beyond 3 also? A small clarification there.
Sir, it is my understanding that I don't know whether there is a limit. I'll be honest with you, I'm not entirely familiar, but I know that you can extend in blocks of 5 years. If it's 3 or more than 3, that is something I will have to come back to you on, because it's a product that it's a product that is driven mostly by banks and post offices. I apologize. That's an answer I don't know entirely.
No problem. Actually, my third round of 5 years is expiring this year. That's why I'm a little bit.
I don't think that.
Okay, yeah, I think that works. Thank you.
Great.
Thanks.
We have Rajesh bhai and Makesh on camera. Both are great investors and very active into the wealth group. Any question, Rajesh bhai, Makesh bhai?
No, because actually I think most of the questions are answered. So I had few concerns about NPS, but Aniruddha answered them well. So NPS thing is cleared. So I had the query on NPS, but it is cleared now.
Perfect. So I'll go to Rajendra. Yeah, Makesh, you have.
Yeah, even I don't have any questions. I think most of the questions are answered, including NPS was something new. So awesome. Though it was actually heard a lot, but I have not done anything on that. So I'm just learning right now. Yeah.
Awesome. That's great. Rajendra Pawar bhai, you want to come on camera and ask your question?
Yeah, I'm just unmute my camera, turn on. So my question is, we are talking about ATC or ATD, but with the new regime, we don't have any ATC, ATD in between. So how we can manage or decide our portfolio based on the tax exemption?
Because unfortunately, under the new Yeah. Sorry, please complete your question, sir. Complete your question.
So like we are saying, we can have 1.5 in ATC, or we have PPF, PF, whatever it is. But in new regime, we don't have ATC, ATD, right? Even in the medical, ATD is not there. So only I think NPS ATCCD is there. 50,000.
So that is the great difficulty with the new tax regime, right? that it takes away all the exemptions and there are excessive slabs. But there is sufficient research which has suggested that, unless you're in the 0 to 15 lakh tax bracket, the newer regime will actually suit you a lot more. As you grow higher in tax regime, 25, 30, 40, 50 crore, it doesn't make sense to do the newer regime. You must be in the older regime because obviously it will also give you these additional benefits of 2.5 lakh rupees and then 2.5 to 5. There is that virtual net slab. You'll actually end up with more money in your pocket if you're on the older regime, if you are above a certain salary bracket. Unfortunately, as long as you're on the new regime, you can have all of these investments. I mean, sometimes the purpose of making investments is, more than the element of saving tax. But because you can't use that in the new regime, that really is it. I mean, you if you want the benefits, then you'll need to go back, and now's the time to do that because you can change it once a year in the beginning of the year.
And one question, I think, for everyone, just the fiasco which happened with the Franklin debt funds a year back or 2 year back. So earlier we used to say that कि debt funds तो हमेशा अच्छे होते हैं, वहाँ पे पैसा minus नहीं होगा. But we had seen that when I need the money, I was not able to withdraw it because something happened with Franklin and all 6 funds were gone down. So how to analyze or how to get feel out of it so that before something happens we can withdraw our money or something. I don't know कि उससे कैसे बच सकते हैं इस टाइप के fiasco से. क्योंकि अगर मैंने आज रखा हो, मुझे 60 years में मुझे चाहिए, चाइल्ड का एजुकेशन है या जो भी है, उस समय मुझे एक मोटा पैसा चाहिए और उसी समय वो फंड ने मना कर दिया.
राजेंद्र भाई, अभी क्या 60 साल बाद?
नहीं, अभी की बात कर रहा हूँ सर. कुछ लोग तो पिछले साल 60 साल वाले थे. आई नो सम पीपल ना, तो उनकी हालत ऐसी थी कि रियली दे वर क्लूलेस एंड दे वर हेल्पलेस. बेटी की शादी है, पैसा लगाया हुआ था, खत्म. फिर उधार लो, कहीं और से जुगाड़ करो, लोन लो, एंड देन दे डिड, क्योंकि शादी तो रुक.
Well, so honestly, you would have to be a genius to guess before time what security is going to default. Look at the last 3-4 years, right? From 2018, actually, which is when the series of defaults happened. Every single security that has actually defaulted in the market has been AAA, right? I think a lot of the blame for that goes to credit agencies who have actually been rating these funds. ILFS happened, DHFL happened. Reliance Capital, Reliance Housing, Altura happened. What actually broke the back for Franklin was the Vodafone default, right, among some of the others. And because of the Vodafone default, there was an excessive pressure to pull money out. Now, a fund can borrow, right? As per SEBI rules, a fund can borrow a certain percentage of its holdings in order to pay back liquidity. So if a fund is, let's say, 5,000 crores, it can borrow up to 10% अगर बहुत सारा redemption pressure अगर आता है, so you can do that. That limit was actually breached across a lot of the Franklin funds. So they had no option but to wind down the securities. Now, we may agree with it or disagree with it, but understand the fundamental question. Like today, there is, how does a fund manager find liquidity? Or let's say, how does an equity fund manager find? How do we find liquidity? We end up selling something, right? Now, if that's something that you're willing to sell, cannot be bought or does not, or nobody wants to buy it from you, so you will end up selling it at a discount, which is called distress sale, right? Now, had Franklin continued to keep the schemes open-ended, would redemption pressure aata? Default to everybody would want to redeem, so he would have had to sell his securities at even a further loss, which were perfectly good securities. So the decision that they took, right or wrong, I don't know, right? But what SEBI has now done is it has now said that if you want to wind down a scheme and you do not have 75% investor consent, you cannot wind down a scheme. So that's the first mitigant that they brought in. At that point in time, in the ambiguity of rules, they wound down the schemes. However, to their credit, every single scheme that was wound down in April of 2020 is actually higher in terms of NAV today as it was 2 years ago. So while we went through that phase of, period in time where we were not able to withdraw money, what Franklin did was it continued to hold on to the good securities because they would have paid when maturity would have happened, as opposed to the defaults that happened. Now, what is the right way to predict this, right? I don't think there is, like I said, there is no magic in this that, who's going to default. We just have to be careful. And that's what Scriptbox does, because so much of our algorithms at play, there is a reason why we don't recommend credit risk funds, for example, or long-term funds. We may stay on the absolute liquid side, and liquids haven't defaulted. So we've tended to stay away from this category where there is any sort of ambiguity. So unfortunately, I don't know whether that answers your question, sir, but there is no way to predict what's not going to work. But whatever happened, was a function of a default by Vodafone, right? And you would not have expected that. And the funny part is that while the schemes got wound down, Vodafone's paid everything back, to its investors, and that's why there is almost a 99%, maybe 93, 94% in some funds, but a 99%, and even one fund is 107% money return. So they've actually ended up returning more money. The answer to your question also is asset allocation, right? So as you're nearing, you need to start winding down some of these aggressive positions, even aggressive debt positions. Now, credit risk is an extremely aggressive fund, right? Because as the name suggests, credit risk, it is actually investing in credit securities which are under AAA. So risk to hai uske andar. So you need to stay. If the horizon or goal or retirement or age 60 or something is, let's say, 1 year out, you need to pull your money back into a liquid fund, or maybe an ultra short term one, or a money market fund, where कि जिस इंस्ट्रूमेंट में इन्वेस्ट करा हुआ है उसकी मेच्योरिटी 3 महीने की है, तो आपका रिस्क ऑटोमेटिकली कम हो जाता है. It's like investing in a 3-month FD. What can go wrong? There is no interest rate risk also in a 3-month. कितना move कर जाएगा interest rate?
Thank you.
Great. I think that was the last question. Thanks a lot, Anirudh. This has been an amazing session. Seriously, we don't let session overflow more than 1 hour, but this has been amazing. Everybody has stayed on. So great session. Thanks a lot, guys. 3 things I want to mention. There's a link for feedback form. Please do submit the feedback form. Second, at EliteCISO, we have a separate Elite Wealth group. If you want to join that, send me a DM on WhatsApp. I will add you to that group. Third is in your chapter groups. Mention about this session. Let people know what they missed. It has been a phenomenal session, right? Great. With that, thanks everyone. Thanks Anirudh. Thanks Pipbox team.
Very good session.
Yeah, enjoy remaining Saturday and Sunday tomorrow. Bye-bye. Thanks a lot, Anirudh.
Thank you so much.
Thanks,
Thank you, guys.
everyone.
Thanks, everyone.
Thank you, guys.
Thank you, everyone.
Great.
Thank you.